Welcome back. Futures indicating a gain at the start of trading this morning ahead of a big week of economic data, largely housing data and the GDP. But we're near the highs of the morning right now. Dow Industrial's up 91, the S&P up 13, and the Nasdaq higher by about 50 points right now. We've got the final read on third quarter GDP out this Thursday, and the personal consumption expenditures report. That index coming out on Friday, along with all of that housing data. Joining me right now to look ahead is the Horizon Investment Head of Portfolio Management, Zach Hill. Zach, great to have you. Thanks very much for being here. How would you assess what we're about to see, whether it's economic growth for the third quarter or the upcoming housing data? What are you expecting?
Good morning, and thanks for having me today, Maria. I think we're getting into that period at the end of the year where, there's a lot more noise than signal. But, as you mentioned, we do get a lot of housing data here today. And that's been really the forefront of, the Fed policy taking a bite on the economy. And so, that's something that we're watching a good bit, in the short term. But in the more medium term, I think we're probably a little bit more optimistic on the housing market than kind of most analysts that are talking about it here today.
Well, I mean, we had a few weeks there when mortgage rates were all the way up to 7.25%, 7.5%. They're back down to 6.31%, dropping again last week. And the week on data includes the National Association of Home Builders index coming out this morning at 10 a.m. That'll give us a read on the current level and future single-family home sales. In December, we'll also get the housing data on housing starts and building permits out tomorrow. Zach, you've seen some demand destruction here, and there are some who say housing is already in recession. Do you expect this area to get worse as the Fed continues raising rates?
I think it's going to be dependent on rates, actually. I mean, we've actually seen, the Fed has been raising rates and mortgage rates have been falling because, of course, Fed policy works through expectations and the way that they message things. And so, it is obviously very, very rate dependent. But, as we take a step back and think about it, there is just a lot of demand, a lot of demographics that are in favor of the housing market, and we've underbuilt for the last 10 years for that. And so, I do expect some weakness in the short term, but as conditions for housing start to improve, you're going to see buyers come off the sidelines, and that's what you've seen over the last few weeks.
Zach, how are you positioning the portfolio going into this final 2 weeks of the year amidst all of these estimates that the economy weakens in 2023? We're down in the double digits year to date, but of course, we've been enjoying this year-end rally for the last month and a half.
Maria, we're not making any changes right now. I mean, as I said earlier, this is a really kind of bumpy time of the year where, if you don't have to transact, it's kind of best not to just because of liquidity considerations. But, what we've been doing really in our portfolios across in the equity space is overweighting value and overweighting defense. We're going to maintain that position, through the end of the year and into the next year. Who knows what the future is going to bring, but as we look out, we think that investors are going to prioritize cash flow and companies that actually make money instead of, some kind of long shot kind of growth stock names.
All right, so you're on defense heading into year end and 23. I'm with Leo Kelly this morning. Leo, how about you jump in here?
Yeah, thanks, Zach. So quick question. The consumer seems to be deteriorating pretty fast. Savings rates are collapsing. Credit card debt is spiraling very quickly. And obviously, we're having this continued struggle in housing. What's it going to take to turn the consumer back around, bring back confidence, and restore the consumer and the economy?
Well, there's this interesting dichotomy. We've kind of seen it this entire year about the consumer, where you survey them, you ask them how they feel. Objectively, they feel horrible. They say their outlook is terrible. They don't like anything. Their buying conditions for homes, cars, you name it, they're as bad as they were, in the 1970s, early 1980s. And so, that's kind of one thing. But what we focus more on is actually what the consumer is actually doing. And what we've seen, and you mentioned a little bit of it, is resilience. It's spending. Yes, the credit card balances have gone up, but they've come up from a very, very low level. The same thing in terms of concern about housing market and spiraling costs there. There aren't that many homes that are getting transacted at 6.5% mortgage rates. That's kind of the point of Fed policy. And so, as we think about it, actually, we see more resilience in the consumer, and really that's predicated on the labor market. That's going to be the big focus for us next year, and certainly, as you heard from Chair Powell last week, that's going to be a big focus for the Fed as well because of the read-through into wage inflation.
For sure. As far as this tight labor market is concerned, they're watching it. So are we. Zach, it's good to see you this morning. Thanks very much.
Thanks, Maria.